Picture this. It's Monday morning. You grab your phone, open your banking app, and try to check your balance, but the app won't load. So you drive to your local branch. When you get there, a crowd is already standing outside. The doors are locked, employees aren't answering, and taped to the window is a message: bank closed. That's it. No reopening date, no customer service number, no promise that you'll ever see your money again. Your emergency fund? Gone. Your next mortgage payment? Gone. The money you saved for your kids' college? That might be gone too. Today, this scenario sounds almost impossible. If an insured American bank fails, depositors generally have federal protection within established limits, but that protection is surprisingly new. For much of American history, depositing money in a bank required a serious leap of faith. If the bank made reckless loans, ran out of cash, or simply disappeared, customers could lose everything. There was no federal deposit insurance, there was no guaranteed rescue, and there certainly wasn't an app telling you everything would be fine. So, how did banking become safe enough that millions of Americans now deposit their paychecks without thinking twice? Well, it took more than a century of panics, failed experiments, political fights, and financial disasters. Let's rewind. In America's early years, banks didn't operate the way they do today. There wasn't one uniform national paper currency circulating everywhere. Instead, many individual banks issued their own notes. Think of each bank creating its own version of money. A bank might give you a paper note promising that you could return later and exchange it for actual gold or silver. If everyone trusted the bank, those notes could be used to buy goods, repay debts, or conduct business. On paper, the arrangement seemed simple. The bank held precious metal in its vault. Its paper notes represented a claim on that metal. But bankers noticed something interesting. Most customers didn't ask for their gold at the same time. So, imagine a bank had $10,000 worth of gold in its vault. Instead of issuing only $10,000 in paper claims, it could issue more, maybe much more. The bank could lend those additional notes, collect interest, and increase its profits. As long as customers remained calm, the system could keep moving. But confidence was doing most of the work. The moment people suspected that a bank didn't have enough gold, they rushed to exchange their notes before everyone else. That created a bank run, and a bank run could destroy even a functioning institution. One nervous customer asks for cash. Someone watching from across the street notices. A rumor begins. Within hours, dozens or even hundreds of people are demanding their money, but the bank doesn't have all that money sitting in a vault. Much of it has already been lent to farmers, merchants, and businesses, so the bank pays the first customers in line. Then it runs out. The doors close. Everyone still waiting outside is left holding paper promises that may now be worthless. And here's the brutal part. Losing your savings didn't necessarily mean someone had broken the law. Banking was treated largely as a private transaction. You had chosen the institution. You had accepted the risk. If that institution failed, the loss was often yours. Americans learned this lesson repeatedly. The country's first major financial crisis arrived in 1819. The years before it had been filled with optimism. Land prices were rising. Credit was easy to obtain. Banks were issuing money. People were borrowing. And speculation was spreading. It felt like prosperity could continue forever. It didn't. Agricultural prices fell. Credit tightened. Loans were called in. Farmers couldn't pay. Businesses collapsed. And banks struggled to meet demands for gold and silver. Families lost property, workers lost jobs, depositors lost savings, and there was no national system prepared to protect them. Still, America didn't respond by building a safer, unified banking structure. In many places, it moved in the opposite direction. After the Second Bank of the United States disappeared in the 1830s, states gained even greater influence over banking. A number of them adopted so-called free banking laws, making it easier to establish new banks. The goal sounded reasonable: increase competition and make banking more accessible. The result was chaos. Some new banks were legitimate, others were dangerously underfunded, and a few were little more than elaborate scams. These questionable institutions became known as wildcat banks. A dishonest operator could establish a bank in a distant location, issue stacks of notes, and send those notes into circulation far away. Redeeming them might require a long, expensive journey. By the time someone reached the bank, it could already be empty. Now imagine running a store during this period. A customer offers you a $5 note, but it isn't issued by the government. It comes from a bank located hundreds of miles away. Is the bank real? Does it have enough reserves? Is the note counterfeit? Is it actually worth $5 or only $3? Ordinary Americans needed specialized publications just to estimate the value of the money in their pockets. Then came the Panic of 1837. Banks suspended payments, businesses failed, unemployment increased, and a severe economic downturn followed. But even that crisis didn't settle the issue. Another panic arrived in 1857, then another in 1873, then 1893. The details changed, but the pattern remained familiar. Good times encouraged risky lending. Rising prices attracted speculation. Banks and investors became overconfident. Then one major company or financial institution collapsed. Fear spread. Credit disappeared. Depositors ran toward the banks, and anyone arriving too late risked losing everything. The Panic of 1873 began after the failure of J. Cook & Company, a respected banking house heavily involved in financing railroad expansion. Its collapse shocked the country. Banks failed. The New York Stock Exchange temporarily closed. Businesses shut down. Railroad construction slowed, and a long economic depression followed. 20 years later, Americans were hit again. During the Panic of 1893, hundreds of banks suspended operations or failed. Thousands of businesses went under. Workers lost jobs across the country. Once again, depositors discovered that a bank balance wasn't the same thing as cash in your hand. It was a promise, and promises could be broken. By the beginning of the 20th century, the weakness was obvious. America had become an industrial giant, but its banking system could still be thrown into chaos by rumors and fear. Then came 1907. The panic began after an unsuccessful attempt to manipulate the stock of a copper company. The scheme collapsed, damaging several financiers and institutions connected to them. Attention soon turned to the Knickerbocker Trust Company, one of New York's largest trust companies. Depositors rushed to withdraw their money. Millions of dollars left the institution within hours. Knickerbocker suspended operations, and panic moved through the city. Other trust companies came under pressure. Banks began holding on to cash. Loans became difficult to obtain. The stock market fell. America still had no central bank capable of coordinating a national response. So a private banker stepped in. J.P. Morgan gathered leading financiers inside his library and pushed them to provide emergency money. He examined which institutions could survive, organized rescue funds, and pressured wealthy bankers to cooperate. His intervention helped contain the crisis. But think about what that meant. The stability of the American financial system depended heavily on one wealthy, unelected individual making decisions inside his private home. That wasn't a system. That was an emergency arrangement. The Panic of 1907 finally created enough pressure for major reform. In 1913, the United States established the Federal Reserve System. The Federal Reserve could support banks during periods of financial stress and help manage the nation's money and credit. Problem solved, right? Not exactly. During the 1920s, the economy expanded rapidly. Stock prices climbed. Consumer borrowing grew. Confidence returned. Once again, people began believing the good times would last. Then the market crashed in 1929. The economic decline that followed damaged businesses, farms, households, and banks across the country. As fear spread, depositors withdrew their money. Bank after bank failed. Between 1930 and early 1933, thousands of American banks suspended operations. People who had spent decades building modest savings could see that money disappear in days. Some families hid cash inside mattresses, walls, and containers buried underground. Trust in the banking system was collapsing. By March 1933, the situation had become so severe that President Franklin D. Roosevelt declared a national banking holiday. Banks temporarily closed while the government evaluated which institutions were strong enough to reopen. But reopening the banks wasn't enough. People needed a reason to trust them again. Later that year, the federal government created a national deposit insurance system. The institution that administered it became known as the Federal Deposit Insurance Corporation, or FDIC. Its purpose was simple but revolutionary. If an insured bank failed, eligible depositors would no longer automatically lose their covered savings. That changed American banking. Deposit insurance didn't make banks incapable of failing. It changed what failure meant for ordinary customers. More importantly, it reduced the incentive to panic. If people believed their covered deposits would remain protected, they were less likely to race toward the bank at the first hint of trouble. Fewer bank runs meant fewer otherwise healthy banks being destroyed by fear alone. So, the next time you check your balance, remember what that number represents. It isn't protected simply because a bank's building looks impressive. It isn't safe because the company has a polished logo. And it isn't guaranteed by trust alone. The confidence Americans place in bank accounts today was built after generations watched their savings disappear. The early banknotes, the wildcat banks, the repeated panics, the rescue of 1907, and the devastation of the Great Depression all pushed the country toward a new idea. Ordinary depositors shouldn't have to become banking experts just to keep their life savings safe. For more than a century, bank customers carried much of that risk themselves. Today, protections exist because history demonstrated what happens when they don't. And sometimes, the institutions we barely notice are the ones created after the greatest amount of pain.